been made that who are the best owners to assist and finance in that transition, and it's the pension plans. I would argue, or at least I'd ask the question based on what track record with the pension plans helping an industry transition from something old to something new. I'm not sure there is a track record there, but I do understand that they are long-term investors, and but I do think there's been a bit of a divest and only invest in green. Let's not do that. Let's not go all that way, and let's continue to invest in the carbon-based economy, but as responsible owners that help in the transition. That's kind of the consensus thinking that's out there now.
Interesting.
And at the same time, when we got out of oil in 2016, it was after a study and that demonstrated that if you take from the soil all the oil that's on the assets, on the balance sheets of the oil companies, then you bust 6 degrees of warming on the planet, and there's not going to be a planet. So at some point, some of those assets will become stranded assets. At some point, someone will be holding it at the time where it's not worth anything, and we decided we didn't want to play that game. So so it's on a monetary basis, on a financial basis, that we got out of oil. Because guessing when it's not going to be worth what it says it's worth right now on the balance sheet is something that is quite risky also.
Jason,
but I think Eric touched a very good point in the terms of there's no track record. The big problem with one of the big problems with the pension funds is that there's fiduciary duty. There's a need to have experts that can prove things before you can do them. So there's a tendency to reproduce what's been done in the past, and it's difficult to innovate. And I think right now we've seen where what's been done in the past with finance has led us, and we need to innovate. So we have to do something about that.
Jason, do you want to chime in on this one, or?
Yeah, I'll just maybe add one thing to the challenges that everyone sort of highlighted already. The challenges around sort of the mindset of the traditional finance professional and what they've been trained in terms of profit maximization. I think that where we're seeing leadership in the pension and the institutional investor space is a change in mindset, is the belief, that Geneviève just highlighted, that Eric is talking about, of that our capital actually not only can do good while we generate returns, but it should. And there's actually a business case for it. And there's a buy-in to that mindset, or that buy-in into that view. So that's one big thing. The other thing that Geneviève mentioned around the size of the investments, a lot of larger institutional investors want to cut $100 million, $200 million, $500 million checks, and those just haven't been available in the Canadian market until recently. Now with the social finance fund, with what Fond d'Action is doing, with Twin Rivers doing, with the pooled fund that they're working on, that's changing. But I think that's going to be a big barrier, the availability of product at the institutional size. The one thing I want to add to that is something that I think Geneviève just was alluding to, which is just knowledge and capability of in the advisor and consultant space of impact investing, impact product, and knowledge and skill sets among investment teams. So, a lot of organizations will have to build the skills to do impact measurement and management, to diligence, an impact deal, which is a new skill that they're adding on top of some of the financial due diligence. So I think one of the key things that came out of a report, a key barrier that we need to solve, is training the future generation of investment professionals, building impact investing knowledge into the certifications, professional associations, the undergraduate, graduate degrees, building that knowledge there, but also educating and building the capacity of investment teams, boards, and executives within financial institutions to understand how to apply impact investing best practices.
So what you're saying is this is going to take a long time. That sounds like a slow process.
Well, even before you get to the impact measurement and management, you have to have the more really vexing kind of discussions, which is what kind of impact and how do you compare these these impacts that are not like for like? How do you prioritize a day avoided in the hospital to a ton of carbon avoided? Like, how do you Like,
Yeah.
which is more important? If you're a pension plan and all the people who you're really servicing are the people, economically anyway, are the people who are retired and are getting your benefit payments, and the people who are putting putting the money into the pension plan, or the longer you've been alive and working, the longer you are. So you do not care about social impact for kids, because they're not either putting money in yet or not taking money out, or they're not your constituents.
Right.
Is that not valid? I mean, some of these once you sort of answer those questions, you start putting money to work. Yes, then you have to learn these new skills about how to do impact measurement and monitoring.
Yeah.
But
Yeah, I know that.
even before you get there, you have to think about, like, what's our purpose in impact, and where are we going to prioritize, and how do we sort of compare apples to oranges?
Yeah. That makes sense. And I'm like, isn't it just pretty self-evident to most people who'd be thinking about this question that, like, solar equals good or affordable housing equals good, that there are some of these, like, social areas that are just, that seems pretty straightforward. We could do that. I guess I wonder if you folks can speak a little bit to, for pension funds that haven't done as much in this space and in impact investments, what are some of the asset classes and sort of social impact areas that might be most relevant for them to look at first? Is it solar bonds? Is it, impact focus, private equity placements? Like, what's the right spot to start?
Well, to us, we've identified three big trends. The green trend obviously is known. So you're talking, yes, climate, GHGs, the climate change, but also companies that will use less resources than others. We use too many resources. We use more than a planet every year, and we should not. So they will have an advantage in the future, and it's just a matter they will actually make more money than others because their costs will be less. So the whole green and biodiversity is also something that we want to take care of more and more. So the whole green trend is very important. Rising inequalities and what that means. So anybody who's working on increasing access to education, food, good food in everywhere, to housing, you said it, to health, being able to have access to healthcare. Those are major trends. There are many people that are being left out right now, and they need solutions, and the governments will need solutions, and everybody will want them to have solutions. Otherwise, we'll get into a lot of trouble in society. Third is inclusion. Again, there's a strong polarization right now of the us between them, us against them. And at the same time, there are more and more movements of population between countries. And so those are two trends that are pushing towards internal major problems. Again, any businesses that are making sure that there is more inclusion, that there's more diversity, that you get to bring people together instead of build things separately. Those will lower your risks. They will lower society risk, but they will lower your risks too. And that's something that we can do fast about pension funds, is to try to enlarge a little that vision of what risk and return is, because return does not have to be for the next quarter. Return is for long-term tendencies, and the long-term tendencies all tend to the fact that we need to become greener, more inclusive, and more equitable. And risk should not be seen as volatility. Risk is systemic risk. Risk is the risk that there are fires, there's inundations, there are all those troubles that are coming up, and that will make the economy very difficult to live with. And you want to be on the right side of things where you are providing solutions and helping the businesses that are using those trends to provide solutions.
Mm-hmm. Eric, Jason, you want to chime in on this one?
Yeah, I'll just really amplify what Genevieve just said about risk and the definition of risk. And there are not many pension plans that have gone out of business because we had a volatile quarter in the market. Right? We measure volatility that way because the academics have trained us as finance professionals that is the shorthand for risk. But in fact, risk is the permanent loss of capital from these more systemic areas that We are so that some businesses are addressing, some countries and organizations are addressing, and others are sticking their head in the sand and ignoring it because it's not hurting them today.
Yeah.
And so, as long-term equity owners, lenders as well, this is a choice we can make of who to back, who to put our money with. That can be both sustainable, resilient, but also make money from solutions.
Yep.
Yeah. Yeah, and I'd agree with Eric and Genevieve, and I think that last point, Eric, is really what we're starting to hear from some of our institutional investor clients, is that Genevieve mentioned this as well, is that actually the greatest investment opportunities out there right now are amongst the innovators that are solving some of these key social and environmental issues. The climate finance boom is years in the making, but one that was so obvious to impact investors a decade ago. And I think that's starting to happen now with, what Genevieve mentioned, social inequality. If we don't solve housing, we have major economic consequences that we're going to have to live with in society. So who are the innovators that are solving, challenges related to access to housing or access to, fair jobs, the work that Social Capital Partners is doing around employee ownership. That's a massive opportunity. KKR is now, one of the biggest private equity funds in the world, is now looking at how do they embed employee ownership into their investment model for a private equity. Like they're recognizing that the companies that are forward thinking, that are, embedding these social factors into their business model, are the great investment opportunities going forward.
And I wonder, practically speaking, what does it look like to change who is in power in pension funds, who gets to make these decisions, and what changes their minds? Genevieve, you were mentioning you had sort of activist constituents, fund members who were pushing you in this direction. Is the same thing true at other pension funds? And how big of a role does that play? Are there other voices that pension fund directors are listening to? Help me understand sort of the inner working of how decisions get made for these pension funds.
Well, I'll take a stab at it. I think, it's sometimes when you work inside one, you wonder who's really calling the shots. It's clear when there's a champion for something new. That's clear. If somebody really believes in something and they're running around socializing it and advocating for it and building a coalition inside the firm because they really truly believe it. And so it can come from within, bottom up. If you have somebody who really believes in something, and I've done that myself a couple of times. Typically, the board does not see themselves as embarking on new things that they believe in, because they haven't done the work. Typically, they're really more there as an oversight body, and I think that's unfortunate. I'd love to see board members who are a little bit more risk-taking and a little bit more forward-thinking on the purpose and the mission of these organizations. But I think they see more downside risk than upside benefit of pushing the boundaries. There are certain beneficiary groups that are, because of their nature, public service type employees, whether it be healthcare workers or teachers, that have a bit more of a voice at the table and an ability to help set the agenda and to ask the right questions and to demand answers. And I think there are governments, like right now, Canada government's asking the question of why Canada pension plans aren't investing more in Canada. So there's a bit more emboldened period of time we're having here, why we're asking, can these pension plans do more than they've done in the past to help? And that's going to be an interesting journey over the next months.
I think we need to get the pension fund holders, the beneficiaries, the people, to actually get more involved. But right now it's very difficult for them as yes, they have representatives on the board, but they're always being told that they need to follow professional advice, that they need to follow whatever has been, because otherwise they're at risk of being sued. Like if you get out of oil and oil does well next quarter, then you worry maybe I will be sued by the people because I make them miss whatever.
Right.
And so the government has a role to play in making sure that there's a wider way of looking at risk and return that makes room for people to do more. We also have to make sure that there's a dialogue between finance and the real economy and the real people out there, because there are people who are really scared of what's going to happen. And the unfortunate thing is that, to me, it's the people who work for the oil companies, for example. They will have to learn new things and change industry. It's the oil companies will not become green, and so there is a change that's going to happen. How is it going to be happening? How are we taking care of people? Are we helping them train? Are we helping them finding these new jobs? Are these new jobs being paid enough? It raises real concerns, and we have to take those into account also.
Yeah. I completely just want to wholeheartedly support that last point, Geneviève, on the just transition and how important it is to consider various stakeholders as we transition capital from one industry to the other. So just want to support that point, and also highlight, I think one of the key recommendations from the report that we worked on with the working group is this idea about beneficiaries starting to have more say, more agency in where their capital is invested. Gabe, you referred to the students when you kicked this panel session off. I think a lot of people are generally might be passive about where some of their retirement income is, but that is changing. That is changing with changing sentiments among the intergenerational wealth transfer that we're going through right now. So more people are actually taking a closer look, and leading pensions like Fondation and many in Europe are actually asking their members to say, what do you want the world to look like when we are paying you out with the funds that we're investing for you, and what do you want that money to be doing right now? So I think that stakeholder voice and campaign, helping them really recognize the power that they have is an important step.
Yeah, no, that's a great point. I wonder about sort of the narrative on the other side, this ESG backlash, woke backlash that we've seen, especially in the US, around where asset holders are putting their capital. Do you folks feel that is impacting pension funds in Canada? Are they deciding to do things differently? Because I imagine some of their constituents, some of their pension holders or future pension holders are reluctant to the idea of sort of assessing investments with an ESG lens.
I mean, I see it as it's a language issue. It's a labeling issue more than anything else. This was a political wedge that was invented against a very shorthand acronym, ESG, to continue to help divide. And so the idea that environmental, social, governance risks, we can just decide that they're not material, and we can decide that investors, when they're looking at a particular investment, can and should ignore those risks and not price them in. That's just not, it shouldn't happen, and it's not happening. Larry Fink, the head of BlackRock, may have changed the tone of his recent annual letter from what he used to say, but everybody at BlackRock is incorporating ESG into their work because we've all learned that these are material risks and opportunities, and so yes, there may be a few public pension plans in particular parts of the United States that have decided they're going to fire managers or tell managers what to do. That is the clear, very small minority of what's going on. But you will see less firms using the acronym for sure.
Yep.
And it's ironic because a lot of people were just relabeling what they were already doing as ESG, and now they can just go unlabel it. But they haven't changed what they were doing at either of those points in time. The other thing you really want to try to get to avoid with the pension plans is them sort of ring fencing some assets that they've already made, the investments that they've already made, and saying, well, this is our impact portfolio, and not changing anything they do. It's just a sort of cherry picked a piece of their portfolio that's either ESG, obviously a very high ESG standards or impact standards, and saying, oh, look, we're doing this now.
Right.
That would be a shame.
Yeah. So we all prefer people who do it without calling it the right thing, instead of people who say they're doing the right thing, but they're not. But it's a very cultural thing. In Europe, it comes from the top and goes down. You have to do this, that. And in US and Canada is like that. It comes from the bottom. People do it, and at some point it becomes the norm. And we are seeing more and more people doing it. It's more and more obvious. Obviously, the insurance companies are very aware that anybody who's involved with anything that has to do with real assets, they have maps. They know where the water is going to rise next time and what's going to happen there to the assets. And so they are incorporating that risk a lot more than sometimes they will say. But at the same time, that's what we want. We want them to take it into account.
Yeah, Jason, in our pre-call, you mentioned in your research, you noted that some pension funds maybe were doing a bit more in impact investments, or at least in sort of SRI-oriented investments, but weren't calling it sort of impact investments. Can you speak a little bit to that, sort of what you saw in your research around what folks are doing and what folks are labeling?
Yeah, I think this conversation about labeling and the ESG backlash is a super interesting one, and one to follow, because I think we're still early in this journey of how this is going to go. And some of the interesting data points are, I think that there was a study done in Texas of what was the economic impact of the ESG divestment movement, and it was hundreds of millions of dollars to the Texas economy just from some of those divestments. And we're seeing challenges with passing legislation around anti-ESG investment policies because, as Eric said, many investors have already had a standard or a process to evaluate the governance of an investment, or things like environmental impact. So that's interesting. I think for the impact investing space, this is a really important question for the industry going forward. And one that we talk a lot about in our report, and that we continue to have with different stakeholders, of labeling risk. So on one side, a pension fund or an institutional investor might be afraid of calling it an impact investment because they're afraid of being criticized for greenwashing, because they don't meet the bar for impact measurement, or they're not very clear about the outcomes that are changing, because there is no very clear bar on what the greenwashing standard is. And then on the other side, calling it impact investing and then being accused, as we're seeing with the ESG movement, that you're conceding returns to do this. So there's this risk that institutional investors are facing, where they might have a very clear investment thesis that's aligned with, we want to invest in businesses that are preparing for a more prosperous economy in the future that address inequality. But will they call it an impact investment because of those two risks that they're feeling on both sides? Maybe not. And so I think that there's something about our industry that we want to reflect on this. One of the solutions we propose is, instead of labeling the product, kind of label the process that investment managers are going through to define how they're taking an impact approach. So where is impact embedded into the investment process? Frameworks like the operating principles for impact management, or now the impact principles being stewarded by the GIN, the Global Impact Investing Network, that just gives you an opportunity for an investor to say, here's where impact is a part of our due diligence process. Here's how we're tracking it through the investment life cycle, and this is how we're going to manage it when we're considering an exit. And here's our strategy. And so, being able for investors to now be able to show how they're following these principles is allowing us to now have more clarity on who's doing this and what are their practices, how are they doing it, without us getting lost in is this investment an impact investment, or does this meet the bar? Is this investment impactful enough? I think that's going to help move things forward.
Yeah, maybe picking up on this piece, Jason, you were mentioning around risk, how pension funds categorize what is risky and what is not risky. I guess I wonder, Eric, maybe throwing to you, how pension funds think about risk vis-a-vis, oil and gas investments or investments in weapons manufacturing. In my mind, I'm like, okay, there are campaigns of pension holders who are calling out those investments, getting media coverage, putting these pension funds on blast for those investments, which they see as misaligned with, the values of the pension holders. Why is it that is not translating into risk, like an assessment of a higher risk for those investments?
Oh, I think it is. I think, in any investment that we would look at inside a pension plan, we would look at risk from multitude of perspectives. You'd look at reputational risk, and that's what you're talking about. This reputation that as an owner of these assets, you would be attacked for, for your participation in something that is so harmful. So there's reputational risks. That's why people would debate. Well, it's not carbon coal; it's metallurgical coal. Well, that's different, right? And so, there's less reputational. How much less reputational risk is there for metallurgical coal than coal for heating? There's reputational risk. There's regulatory risk. There's financial risk. There's environmental risk. So you would look at all those. I mean, in a sound process, you would look at all those different risks. But the caveat is that if the return is high enough, then your typical pension investor would say, well, it's compensating for those risks, and therefore we're still going to do it. Right? Whereas some others of us might say, well, there are some risks that we're just not willing to take. I marched down to somebody's office once and I said of a particular investment, like, don't even bother with this one. Like, I will kill it in committee 4 months after you've wasted a lot of your time on work. I can tell you that right now, given the business model. And it wasn't an
Because
environmental.
it was going to be.
No, it was like it was a multi-level marmarketing thing. So, the whole basis of the company is that you'll get thin and you'll get rich, and 99% of the customers do neither.
Right. Okay.
Yeah. We see the risk. We now need to see all the opportunities. I think the people who have been involved in renewable energy, for example, are now seeing how much there's the winds in their back helping them with the IRA. So it's not just a matter of we need to care for the risk. It's a matter of seizing these great opportunities that are there. Impact investing is helping in the right trends, but those trends are what's going to make money.
And
wonderful.
Those are big opportunities,
They
very big scale opportunities that you could put a lot of capital behind. And there are a lot of large plans and a lot of large investors who are building big teams for the energy transition.
Housing,
across the whole cycle.
Jason mentioned that earlier. There are great opportunities in the impact investment area.
Wonderful. Well, that seems like as good a place as any to end it on. We got to a slightly optimistic note on the end. So thank you so much, Jason, Geneviève, and Eric, for joining. This is a blast. Appreciate you making the time.
Thank you.
Thank you.
Thank you, Gabe.